And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the second best day of the week as we get ready to move into the weekend. Of course, a very important day today, Veterans Day. Of course, this is where we acknowledge and honor those that have served in our military and are still alive, of course. And this is the thing. I heard a very interesting comment on the radio this morning driving in, talking about that, we need to honor and respect the sacrifices that our veterans made in defense of the freedoms and the Constitution of the United States. Absolutely correct. Absolutely right. Maybe we should stop doing things to actually violate the Constitution. That might be a good idea. Instead of moving the country towards socialism, maybe that would be a better way to respect our veterans. So anyway, we do respect our veterans and we do honor them very much today, and we do appreciate your service and sacrifice here on Veterans Day. My grandmother, who, if she was still alive today, she passed away a few years ago at the ripe old age of 103.
Wow.
She was born on November the 11th, 1911.
Yeah.
So today would be her 109th birthday. So no, 8th birthday. So, yeah.
Pretty amazing generation they were.
An amazing generation. They just won't die for some reason. They just hang in there, Anyway, they talk about longevity. They say, we're living longer now as, we're getting better medications and stuff.
Right.
We've got a lot of people from World War II just celebrated a birthday yesterday for a World War II veteran that just turned 100. So, we talk about all these longevity living, drugs that we have, but, a lot of those people born back in World War II still hanging around. So.
And they didn't need all those drugs.
They did need all those drugs. So anyway, a couple of things to get into today. Yesterday, of course, big inflation number. We're going to talk about that with Michael Leibowitz this morning. Does this put the Federal Reserve into a bit of a box? Inflation coming in yesterday, well over 6% on a year-over-year rate of change. Of course, again, the immediate blame's going back to the fact that this is part of the supply chain disruption, and we've got lots of demand coming in as the economy reopens. And, that story only holds water for so long. The economy's reopened. We've got people back to work. We're back to almost the lowest unemployment rate on record. So, again, some of these things are policy-driven changes to inflation that is causing things. Things like shutting down pipelines and reducing domestic production of oil and gas. That's leading to higher gas prices at the pump. And that's just something that's not going to change. That isn't transitory until you start to change the supply-demand equation, and you're not doing anything productive in that manner to do that, right? The continued push towards non-efficient, climate-friendly electricity and energy production is fine, except it reduces the supply of oil, which is our main provider of electricity, energy, and consumption in the United States. So again, you are making political choices that have a long-term impact on inflation. And this may be a real frustrating point for the Federal Reserve that is currently hoping that inflation will get back to normal sooner rather than later, and they won't have to raise interest rates as fast. I'm not so sure that's the case, but we're going to talk about that with Michael Leibowitz in more detail here in just a few minutes. However, higher interest rates obviously affecting the stock market yesterday. The S&P was down a bit yesterday. Again, this sell-off in the market, inflation was the excuse yesterday, but the sell-off really wasn't surprising. Again, markets were very overbought going into yesterday, and really the day before. The markets have actually been kind of teetering here the last couple of days. Our money flow sell signal was in place. We're very close now to triggering that confirming MACD sell signal. So again, markets are set to open up a little bit this morning, so we'll see how the market kind of plays out today. But there's certainly deterioration in the indicators suggesting that there may be a bit more selling pressure here over the next few days. So again, as we've kind of been recommending the last few days, raise a little bit of cash, take a little bit of money off the table here, and wait for this, this kind of cycle to work through itself, and you'll have an opportunity to put that money back to work. The bigger news yesterday, of course, and we talked about this yesterday morning, was the fact that we needed to reduce our position in bonds, at least temporarily. Bonds were pushing up towards 2 standard deviations, and of course, very extended after this recent rally. Bonds had a very nice run from $140 up to about $150 on TLT. That's the 20-year bond equivalent. And we talked yesterday about taking some money off the table there, taking some profits in that trade, because we were also triggering a sell signal there as well. That turned out to be a good move yesterday morning. We did reduce that position. Inflation came in a lot hotter, and then bonds sold off yesterday pretty sharply. So again, there's probably some more downside pressure on bond prices in the short term here over the next couple of days. Wouldn't be surprised to see yields move up a little bit more here. There's a lot of expectation. Goldman Sachs has a chart out this morning expecting that interest rates are going to go to 2.5%. That's probably not going to be the case. Again, when we start talking about a highly indebted and leveraged economy, whether it's a stock market leverage through margin debt, or whether it's home equity, home leverage, and either through mortgages or home equity loans, which we have a lot of right now, leverage loans, corporate loans, consumer credit loans. I mean, pretty much you look anywhere in the economy, just a tremendous amount of debt and leverage through the system, all based and predicated on very low levels of interest rates. So if interest rates start to move up too much, first of all, new loans being taken out will slow down, because the psychological impact will be that consumers and borrowers will say, well, I'll wait till rates come back down again so I can borrow cheaper. So they stop making loan activity. And then the second, which also slows the economy, by the way. And secondly, once interest rates move up enough, they stop buying things because they can't afford it. So again, higher interest rates probably not in the cards, so to speak, here, because so much of the economy is now predicated on having low interest rates as a function of consumption. And so there's a real problem here for interest rates to move higher. And again, while there's lots of bond gurus and people in the financial media going, oh, interest rates have to move up because they're so low, that's not really the case. Interest rates are low for a reason. Now, this is an important point, because back in the late 1990s, the Federal Reserve really kind of crossed the Rubicon, so to speak, here, where low interest rates were no longer benefiting the economy. In other words, it was always believed in the 80s and early 90s that lower interest rates would lead to more economic activity. In other words, people would borrow money at lower rates because it was cheap money, and then they would invest that capital into growing something else that had a higher rate of return. The problem is that as more debt and leverage piled up in the system, well, that debt no longer produced positive economic outcomes. It actually became a drag on economic growth. And therefore, lower interest rates didn't stimulate more borrowing. It simply just stimulated the need for more debt just to sustain economic growth at the rate it was growing at. And of course, the more debt we've piled on, the slower the rate of economic growth has been. And again, it now requires more and more debt just to sustain very low rates of economic growth, around 2%. So this is the problem with debt ultimately, and the one thing that we really haven't come to rationalize is the problem. We keep assuming that if we just issue more debt, that somehow magically we'll start to dig ourselves out of this debt problem that we have, but we keep getting further into it. In fact, just yesterday they talked about the national deficit, now $2.7 trillion. Wasn't as bad as expected. It's still $2.7 trillion deficit. We're going to come back, pick up with inflation, the impact on the markets, and your money with Michael Liebowitz, CFA, right after the break. Don't go away.
Delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us.
and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately, for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number. It's 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. Of course, Michael Leibowitz joining me as well. Be sure and get by our website, realinvestmentadvice.com, and get signed up for this weekend's event. It's Candid Coffee. I'm going to be joining Richard Rosso and Danny Ratliff to talk a little bit about the market, the outlook for 2022, and we'll be starting that at 8 o'clock on Saturday morning, so grab a cup of coffee. Join us for Candid Coffee. You can sign up for the event right now online at realinvestmentadvice.com. Best of all, you do have to pay for your own coffee, but it's free. So there you go. Michael Lee was joining them this morning. So yeah, yesterday, Mike, of course, this inflation number came in even really hotter than a lot of analysts expected, well over 6%. And, this, kind of immediately kind of shook the markets. Of course, we saw the bond market sell off here a bit. Stocks were down. Of course, technology stocks, which are the most sensitive to higher rates of inflation, they were down the most, about 1.6% yesterday. A fairly decent decline for tech stocks yesterday. The question, though, now becomes really, the Fed's got a potential choice here. The Fed keeps hoping this is transitory and that by sometime mid-next summer, we should be back to norms in terms of inflation around that 2% target rate that they want. But this inflation is starting to seem a whole lot more permanent than transitory.
Well, the problem they face is they're trying to predict the unpredictable. This isn't a typical economic inflation issue like we've seen in the past 20, 30 years. This, as we know, is largely a function of supply line problems, shortages, shipping, trucking, you name it, right? Mm-hmm. And it's a function of changing behaviors of consumers. First of all, you go back a year and change ago and consumers were given a whole lot of money to spend, right? Now, a lot of that money is gone, but there is still some savings and consumer habits seem to be changing as well. So the Fed has very little effect on supply lines. They have very little effect on behaviors. And so what the Fed is banking on is that the supply line problems go away as, kind of COVID goes away, right? Mm-hmm. And that makes a lot of sense. And I think we would tend to agree with them. Here's the wild card, though. The wild card is our behaviors are changing. So, for instance, I looked at I still get a physical newspaper, Lance, and I look at the front page. I'm in the D.C. area, get the Washington Post. 2 of the 3 articles above the fold, for our younger listeners, that means the top half, were inflation articles. And I forgot the titles, but one of them was kind of scary. So the problem with this is, as the word inflation and as stories about inflation infiltrate, traditional news, be it TV, be it newspaper, social media, internet, just cocktail party conversation, sitting on the sidelines at a soccer game and people talking about inflation, the concern for inflation or inflation expectations rise. And that also changes our behavior. Maybe next time you go shopping, you buy 3 widgets instead of 2 widgets, or, you kind of plan ahead and you start buying stuff, and that starts having an effect. Maybe you go into work and say, hey, boss, prices are up 6%, 6.2%. According to the government, I got a 2% raise. You need to pay me more. Mm-hmm. And because there's a worker shortage, a lot of bosses are going to have to pay more. And what are they going to do? Well, I'll pay Joe more, but then I'm going to raise the price of widgets a little bit more to basically pay Joe. And you get into this trap. And that's the risk. The risk is the Fed may be right that supply line shortages go away. And I say maybe because I don't think anyone really knows. This is incredible what is still going on at some of these ports and throughout the world, not just the LA port that they talk about. Mm-hmm. So the Fed runs the risk that not only do the supply line problems not solve themselves as quickly as they think, but our behaviors around consumption and our expectations change. And they're already way behind the 8 ball, right? CPI was 6.2%. Mm-hmm. Their objective is 2%. And I think we both argue, Lance, that CPI is a very conservative measure, right? I don't think it's a stretch to say that inflation is running somewhere between 8 to 10% for the things that we buy and use.
Right. Well, it's interesting, just for this weekend's newsletter, I'm actually working on a chart because, we take a look at CPI, and I've got a couple of comments about a couple of things you said here. I'll come back to about the supply line shutdowns as well. But, I ran a couple of charts on inflation over the weekend for the newsletter. One is the typical CPI, right? And then of course, CPI, core CPI, which is what, we focus on. Now, that's X food, X energy and food, right? So that's supposedly that strips out the volatility in inflation and really gets down to the core of what we pay for. But if you take a look at some of the some of the areas that are increasing the fastest, that's rent incomes and that is actual healthcare costs. Those are going up the fastest. So, but those things for most people, and this is, I think, an error that we make and when we take a look at core CPI, is the things that we pay for are the food and the energy, right? That's going to the store every week, and maybe I need to buy 3 things rather than 2 things just to make sure I have them on the shelf just because in case they run out. But our mortgage or our rent, either one, and our health care pretty much doesn't change because those are contractually obligated, for a period of time. So in other words, if I have a mortgage payment, my mortgage payment doesn't change from month to month. It's the same mortgage payment for 30 years. If I go buy a new house, I may have to pay up for the house, which would be inflation. My mortgage might go up, but I'm not flipping my house every day. Health care, I pretty much have a set premium, and that changes once a year as I re-up for my insurance, right? So those things really don't change. So if you strip those 2 things out, now here was a shocking number for me, right? So let's look at CPI X healthcare and X home prices or homeowners equivalent rent. That inflation rate, which people are paying for every day, is 8.2%. So again, to your point, Mike, it's not 6.2, it's 8.2, and that's really what people are dealing with. And when you start looking at the fact that wages aren't even keeping up with inflation, that's even a bigger problem for most.
Right. Well, and we've talked about this. We did an article on this, I think it was May, June, April, somewhere back in there, and we broke down inflation into its 300-ish components, right? Mm-hmm. And we showed that used car prices, energy prices, rental car prices, there were about 6 or 7 big ticket, not big items, but items that were driving the inflation rate. And at the same time, we showed that kind of the core. So if you kind of just look at those middle prices, the other stuff that's not going up 10, 20, 30%, it was starting to go up a little, but it wasn't concerning. Now what we're finding is that median prices. So this is, we talk about the breadth of the market. We want to know what the stocks, not the FANG stocks, but what are the smaller stocks doing? And that's what median inflation does. It looks at just kind of the core, the middle, not the ones dropping in price, not the ones rapidly rising, but the middle. And that's rising now at the fastest rate since the early 1980s. And that's right. So that's telling you that the prices of everything are starting to increase. And it's not just used cars, and it's not used cars we can account for, right? That's an easy narrative to say, okay, used cars are going up because there's a chip shortage. There are no new cars. No one's turning in their used cars, right? That's easy. That's simple. But when you start talking about 70 items, right, things that we use every day, that's a very different story. And the Fed, this goes back to, why is the Fed dragging their feet? What are they doing? They see this, and they may, they're kind of betting, like you said, that this problem is supply line. It'll go away. And again, it could be, but they got a lot on the table right now that they're betting on, and they're not sitting on a pair of aces.
Right. Well, the thing is that we keep talking about the fact that, well, these supply lines will clear themselves up, and it's just because of the pandemic. Well, look, 80% of the population-ish, I don't know the exact number off the top of my head, but roughly 80% of the population has been vaccinated in some form, either one shot or two shots, whatever. It's a big number. And again, I may be wrong on the number, but you get my point, is that a lot of people have been vaccinated. People are going back to work. People are getting out. I mean, look, we just had this Astroworld concert fiasco. I mean, 50,000 people at the concert. People are going back out into the world. So, it's a function that, it's hard to start to keep pinning this on the COVID issue, because we are moving past that, economically speaking. And the issue really comes down to, it's really a lack of truckers and drivers willing to take stuff off the ports and bottlenecks at these ports. Production is coming back online. This is not something that may resolve itself in the short term. It's not like magically we're going to wake up tomorrow and have an extra 50,000 truckers hitting the road. They're not all sitting at home right now. They're working. Right. So I'm not so sure that this idea that it's transient simply because of trucking problems is going to turn out to be the case. In other words, what you can potentially make the case for is this is going to last a lot longer than what the Fed expects. And something you and I have talked about before is probably that the Fed is very, as you just said, the Fed is very behind the curve here on hiking rates. But the only reason they don't want to hike rates here is because they don't want to disrupt the stock market. Because again, if they have a big drop in the stock market because they start aggressively hiking rates to combat, inflation, then they've got a loss of consumer confidence, which consumer confidence is already weak. Corporate CEO confidence is already declining. They're really in a very bad spot between trying to support asset prices to keep confidence up and this problem of inflation, which is now impacting consumers head on. It really kind of looks like the Fed's trapped, and they've got kind of a no-win situation here.
Right. And that my article that we published yesterday discusses just that. So maybe when we come back from the break, we can kind of walk through that article a little bit and explain why we think there's some ulterior motive.
Ulterior motives. Yes.
Ulterior.
All right. We'll be back after the break as we will get into the stock market, the Fed's propensity to support asset prices, even though, and I've got an article coming up on this here in the next couple of days, the Fed has already acknowledged that valuations are a problem. The question is can they do anything about it? Talk about that with Michael Leibowitz right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and market, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. RealInvestmentAdvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know that we've gotten to the peak mania point when you see everybody rushing out now to do a SPAC, special purpose acquisition vehicles. A-Rod has come out with his own SPAC. Colin Kaepernick has one. Shaquille O'Neal has one. A new one out this morning. Climate change crisis is real. You want to raise money for a cause?
Listen to the Real Investment Show podcast from your favorite service.
Start a SPAC.
Same show, your schedule at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. I'm Rose Lance Roberts. Michael Leibowitz joining me, talking a little bit about inflation. Of course, that is the big topic from yesterday. Big surge in inflation on a year-over-year basis. And the hope is, of course, that, as everybody's hoping, is that inflation is transitory and magically it will just go away here shortly and we'll all be back to normal at precisely 2% inflation, because that's what the Fed wants to have. And what's interesting is that the Federal Reserve actually believes they can actually control inflation, or they have any influence over it through their actions. And basically, we go back in history and find out more than not that they're the cause of problems in the economy rather than the solution to it, and just a function of financial mistakes going all the way back to the early 80s, through their actions. So, it is interesting, though, that in 2010, and we've talked about this on the show before, Ben Bernanke made a very interesting statement. In the process of launching the second round of quantitative easing, so stepping back a second, in 2008, we had the financial crisis. Then in early, really kind of late 2008, early 2009, we started the first round of this new monetary policy process called quantitative easing. And this was a fancy term for basically the government monetizing debt. And this was, kind of the new intervention. And that was to be about $1 trillion worth of activity. And it was scheduled to end. It had a scheduled start date and an end date. It was scheduled to end in June. of 2009. And so when we got to that point and quantitative easing started to roll off, all of a sudden the market started to decline again, and the markets were down 10, 15%. And that was when Ben Bernanke came out and said, look, we need another round of quantitative easing. And the reason we're doing this is to help spur asset prices, because higher asset prices increase consumer confidence. And if consumers are confident, they'll go out and spend more money, and that helps economic growth. And this was the first moment where there was a verbal acknowledgement of a third mandate. Now, the two mandates of the Federal Reserve are making sure there's not a runaway inflation and making sure we have full employment. That's their congressional mandate. Well, now they added this third one. This was a new verbal acknowledgement of this third mandate, which was to support asset prices. Well, here we are, 12 years later, roughly, and markets are, at all-time highs, and we are now in the process of doing $120 billion a month to help support asset prices. And the Fed is now finally acknowledging that, well, maybe valuations are a bit excessive here, but we're not going to do anything about it at this point because we still need to maintain these monetary policies to help support asset prices. Now, this is the point we left off with. The biggest problem for the asset markets is higher interest rates. You start hiking interest rates, as I said early in the show this morning, in a highly leveraged economy, interest rates have everything to do with outcomes, and it has everything to do with economic growth. So hiking rates does exactly what you would expect it to do. It will slow economic growth. If you slow economic growth, earnings slow. If earnings slow, well, valuations and overvalued stocks become a problem. Mike, so summing all that up and coming to you, this is kind of what you touched on in your article yesterday, and this is why we're talking about the Fed being in a bit of a trap here, is they're really kind of caught in between this issue of hiking rates to slow down inflation. But if they do that, they're going to have a problem in the stock market.
Exactly. And, let's kind of look at their two mandates. It's stable prices and maximum employment, right? We don't have to discuss prices. We all know they're anything but stable, right? CPI is running 6%, and even the Fed, even Powell is telling you that prices are elevated and may stay that way for a while, right? So they clearly should be doing work to control prices. By work, I mean raising interest rates and stopping QE yesterday, right? But they lean on maximum employment. We're not at maximum employment yet. And when you look at the traditional measures of the unemployment rate, we're pretty much there, right? It's 4.6. The average over the last 5 years was 4.4. It's not quite to where we were at late 2019. But if you go back and look at history, we're well below average, and we're at the average of the last 5 years, right? But Powell will say, well, you need to look at alternative measures because there's nothing normal about what's going on, and that's a fair point. So the BLS also publishes the U6, which includes all the people unemployed in the traditional unemployment rate, plus those that are disparaged, those that are working part-time and want full-time jobs. And that number is actually below the average of where it was in the 5 years leading up to the pandemic, right? So by that measure, and again, it's also at the lows of the last 20 plus years. So by those kind of more traditional measures, employment is back to maximum levels. He likes to lean on the participation rate. So how many people are working out of the entire population? And if you look at it, he's correct that it has dropped, and it's only recovered about halfway from where it was. The problem with that is that, like I said, we were talking about consumer behaviors. Employee behaviors have changed too. Many people want to stay at home and take care of their kids. It's too expensive to have childcare, and they have done the math, and they are willing to leave the workforce to take care of their kids. A lot of older people have decided to retire. Right? They were planning on it anyway. Maybe they sped it up a year or two. They don't want to go back to the office, and they're comfortable, right? We also have talked about what's called the quits rate. So how many people are quitting jobs because they think they can get a better job, higher paying job, whatever it may be, better location, whatever they're looking for? Well, that rate is up 0.6%. So if you just subtract that from unemployment, we're well below averages. But if you factor all that in, the participation rate is probably exactly where it was, if not even slightly better than before the pandemic. So I think my opinion is that we have maximized employment. And then you just look at like how many jobs are available versus the number of people unemployed. And we're approaching 2 to 1, right? This is about as robust a workforce as we can have. So the question is, what is the Fed doing? And Lance, you talked about this. They've created their third mandate, not Congress, but them, financial stability, right? And to them, that means higher asset prices. But what they fail to understand is that things may seem very stable right now, but they're actually incredibly unstable because valuations are over twice anything that's normal, right? We have valuations that are in line with 1999 and above that of 1929, right? So every day we go on, oh, the markets are great, they're going up, they're very stable, everything seems hunky-dory, but that's not the fact. They're creating an incredible amount of instability in the markets. Again, prices are running really hot right now, and employment is maximized. So again, this all comes back to why are they possibly dragging their feet so much to not raise rates and to reduce QE? And I think the answer is they don't want to deal with that with the financial markets and what's going to happen when stocks reprice to normal levels, when bond yields reprice to normal levels, and all other assets, including housing as well.
Mm-hmm. Well, and again, this is one of the interesting things I think, and this goes back to, they've had repeated attempts at this over the last, really decade. And we go back to 2018 and the Federal Reserve had started in 2016, starting to taper their balance sheet, had gotten down to where they were just rolling over maturing bonds. They weren't expanding their balance sheet, but they weren't really reducing it either. And then 2018, they actually started tapering off their balance sheet and were hiking interest rates. So they were actually removing that monetary policy from the system. And of course, in September, they go, well, we're not anywhere near the neutral rate. The market declines by 20%. And by December, they're talking about, okay, we're not going to hike rates anymore. And we're, going to get this thing straightened out. And it was in June of the next year, they went back to zero in interest rates because of the markets. So, they keep getting themselves in this position, and I think they're doing it backwards because the first thing they do is they take away the quantitative easing, which is supporting asset prices. And then they go, okay, we're going to take away that part, and then we're going to hike interest rates. Well, what they should be doing is keeping the $120 billion a month going right now, hike interest rates, and allow that monetary liquidity to support asset prices while they're hiking interest rates and trying to quell the inflationary problem. It seems to me they do this backwards. Hike interest rates first, and then take away the monetary punch bowl. And by that time, hopefully, stocks can kind of figure it out and kind of reprice themselves gradually rather than having a shock revaluation like you had in 2018.
Right. I would actually argue that the problem with raising rates is that there is such an incredible amount of leverage in the system, especially at an institutional level.
Yep.
And all that leverage is predicated on zero rates. They pay nothing to borrow money. So taking on leverage is very easy. So as soon as you start raising rates, you start increasing the cost of leverage, and that they'll decrease leverage, which is forced selling. So, they're really trapped here, Lance.
And look, and this goes to the whole idea of, I was reading an interesting article about, talking about leverage. Interesting article yesterday. This whole idea of we need to tax the rich more, right? Because they just make way too much money. Take a look at Elon Musk. Elon Musk can't sell it. He had to go to Twitter to get permission to sell his shares because if he was just selling them on his own, he would have tanked the stock. Everybody lose confidence. Oh, Elon Musk must be losing confidence in Tesla because he's selling his shares. So he goes very public to sell his shares. And he says, look, I've got to sell shares in order to pay taxes. Well, if he doesn't take a salary or a bonus, where's he getting his money? You'll be surprised how this works out for a lot of uber rich people. We'll talk about that right after the break. Don't go away.
Daily investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So big news earlier this week was Elon Musk going on to Twitter asking, Twitter basically, and he had almost 4 million responses saying, hey, would it be okay if I sold 10% of my shares? As an individual, I don't take a salary or a bonus from work, and all my wealth is basically in shares, and if you want me to pay taxes, and of course this was kind of a jab at the idea of the Biden administration to tax capital gains and to really go after these rich people because they don't pay any taxes. There's a reason they don't pay taxes. And Elon Musk is a great example of why, as an individual, he doesn't pay taxes. All his wealth, as he says, and he's correct about this, all his wealth is in his stock, right? The stock of his company. And he doesn't take a salary and he doesn't take a bonus from a company. So how does he live? Well, as most of these uber rich individuals do that have publicly traded company stock, they go to the bank and they borrow the money. So they're more than a bank. Look, if you're Elon Musk and you walk into the bank of JP Morgan and Wells Fargo, the criminal enterprise, whatever, they will bend over backwards to loan you millions of dollars against your company stock for 3% interest or 2% interest or whatever the going rate is. So these very rich people, they buy houses and cars and jets and all this other type of stuff on loans against their company stock. Because if they sell their company stock, they've got to pay what? 20% in taxes on those gains. And so this idea that, and this is why, and let me back up one second, and this is why they don't pay any income taxes, because the loans aren't income, they're loans. So there's no taxes due on that income, right? Because it's not income. It's they've borrowed the money against their company stock. Now, at some point down the road, they'll sell their company stock, pay off the loans, and then it's all fine and dandy. But what was interesting for Elon Musk is that he went to Twitter, said, hey, look, I don't take any salary. And the government's talking about taxing my capital gains. So he was actually kind of asking permission. Hey, would it be okay if I sell my stock? Because as an insider of the company, then think about Jeff Bezos, think about all the other, heads of these companies that are highly compensated through stock options and stock grants. if they start selling their shares and just kind of behind the scenes, again, the market looks at that as like, oh my gosh, what's Elon Musk thinking? What's Jeff Bezos thinking? And they must think there's something wrong with the company. And then everybody starts selling their shares and the stock price goes down markedly, which, the owners of these companies don't want because they're compensated by their stock. They build their wealth through rising stock option compensation as the prices go up. So what was brilliant about Elon Musk asking Twitter if he could sell some shares is that he got approval. So it's not that, he's selling shares because he thinks something's wrong with the company. He asked permission. This was something that's never been done before by a CEO of a company. And 4 million people said, sure, go ahead and sell some shares. Stock was down, probably 10% day before yesterday as both him and his brother sold $5 billion worth of shares. So now Elon Musk has $5 billion of cash. Now he'll pay $1 billion of that in taxes, but he'll have $4 billion in cash. Now you can't really look. $4 billion is not that much money. You really can't live a lifestyle on $4 billion. But hey, it's some left pocket change if you need it. Mike, your thoughts?
I'd like to try to live on $1 billion or two. See if I can make it.
I don't know. With my wife's shopping bonanza on Christmas trees this year, I don't know if I need at least $2 billion.
Right. But Lance, don't you agree that there's a problem? It's not. I don't think that collecting taxes on unrealized gains is the answer. But shouldn't Elon Musk be taxed in some way? Right. I know he'll get taxed ultimately, or his estate will get taxed. Mm-hmm. But why is it that the working man, almost everyone, pays taxes on their income, and Elon Musk and others pay zero taxes? Shouldn't they pay taxes when they receive options or they receive shares?
Well, and that's a great question, right? Look, as we always say, what's always important to remember is like, if you don't like the game, right, don't hate the player, change the game.
Right.
And, the tax code is the problem. The tax code says and classifies what income is. And since the mid-'90s, when we reinstated stock options, and look, stock buybacks by corporations, those were illegal until 1990. And now we've reinstated stock buybacks. And then when Bill Clinton came in and said, hey, we need to rein in CEO compensation. Now, this is an important point to what Mike is saying. Prior to 1998, most CEOs were compensated through salary and bonuses, right? So they were paying taxes. And then in the late 1990s, Bill Clinton said, well, we're going to limit CEO pay to $1 million. And then this is when Wall Street really came around saying, okay, fine, limit them to $1 million in income. We'll just do it all through stock options and grants. And that was the workaround for compensating CEOs to a tremendous degree, much more so than actual pay. And if you had left things alone, there's a cap to how much income can be paid out to a CEO because it's what happens at the bottom line. It's the cash that's left over, right? So with stock options, though, you can create vast amounts of wealth because of the leverage that is imputed inside of a stock option on stock prices. So CEOs got vastly wealthy on the stock options, which would have never occurred under a normal salary scheme that we had, but previously to 1998. So, the best of intentions to try to fix this compensation, boondoggle we've got continues to make things worse. So now we're going, okay, well now they're all compensated in stock. They're vastly wealthy. They're not paying any taxes. Well, this is what you did to yourself. Pay a salary, have the board of shareholders, approve these salaries for CEOs, and compensation will come down naturally. But to your point, Mike, now I digressed, but to your point, yeah, sure, tax the stock options, at issue date.
But here, excuse me, here's the other point. The other consequence is that you're now paying, and you have been for 20 plus years, paying CEOs in shares.
Right.
Their only incentive right now is to get the share price up, which is fine, right?
Right, which is why 40% of reported earnings are fudged by CFOs and CEOs of corporations.
Right. Right. If your goal is to get them up by increasing your earnings and productivity and making a bigger company, that's great. That, in theory and textbooks, is how it's supposed to work. Mm-hmm. But in the real world, it works by jawboning the markets, by buying back your own stock and doing whatever it takes to get the stock higher today and tomorrow. And a lot of times at the expense of 10 years from now.
Right. And then, look, and let's be honest, the Fed's been a crucial backbone in making sure that we inflate asset prices. And we talked about this previously. Look, if you left the market to its own devices, the market would be around 2,800, not 4,700. The differential is stock buybacks. Right. And, that has been supported by low interest rates, and that's also been supported by massive amounts of monetary liquidity. Tesla wouldn't be trading at $1,000 a share, had we not had all this liquidity injection by the Fed. It's just, and really even by the government, these $1,400 checks, the stimulus, pumped into the market last year, has led to this. Low interest rates have led to a massive amount of leverage by investors into the stock market as well. So again, we're all sitting around complaining about making these CEOs uber wealthy, but it's the very policies that are run by the Fed and the government and the markets that are creating that problem. So, again, what are we really trying to accomplish here? If we really want to accomplish something, let's fix the markets. The markets will fix CEO compensation directly.
Right. And this is, when I was talking about financial stability, this is the instability that is happening right now, right? It's what you just said. Mm-hmm. The true value without buybacks is what, 2,800?
Yep.
And we're at 4,600-ish?
Yeah, 46, 47.
4,700?
It's 40% difference.
Right. There's your instability.
Right.
Last time we had instability like this was the 1920s when buybacks were legal. Same thing happened, right? If we go back to August of 29, everyone would say, oh, the system's great. It's so stable. Stock prices go up every day. Everything's wonderful.
We've reached a permanently high plateau.
Exactly. And that's exactly what didn't happen. Right. And that's when buybacks were banned after 1929. And then they came back to life.
But again, it came back. These things came back to life at the request of corporations and really driven by Wall Street. Wall Street was demanding these things. So, this is, and again, we keep focusing on the wrong issues. We keep focusing on these rich people. Look, okay, let's take away all of Jeff Bezos' wealth. Let's take away all of Elon Musk's wealth, and let's pay off the debt with it. You won't even notice a bump on our national debt that's out there that we've reduced it by. And then who are you going to go get money from? Right now, you've wiped out all the wealth of all the rich people in the world. So where else are you going to get wealth from? And now they have to close down their businesses because they have no money. So now we've lost all those jobs. Who's going to create the jobs, right? And now once you've taken away the incentive to take risks to create jobs and be an inventor and be an innovator in the economy, then what do you have? And this is the problem. Again, you can drive the roots of inequality all the way back to Wall Street, which is where it all begins. And instead of focusing and fixing Wall Street, we keep trying to fix the end result of what Wall Street has done, which is trying to tinker around with tax codes and, trying to fix a little problem here or there. But it all, the cancer starts at Wall Street, and we keep trying to cure the symptoms of it. So, that's the problem. Mike, thanks so much for joining us today. That is The Real Investment Show. We'll be back tomorrow morning for Financial Fitness Friday with Richard and Danny. And then make sure that you're registered for this weekend's Candid Coffee. We're going to talk about markets, money, outlooks for 2022, and what we expect to happen. That's Saturday morning, 8 o'clock. That's Candid Coffee. I'll be there as well. So sign up at the website now, realinvestmentadvice.com.
It's a rich man's world.